Latest manufacturing sector numbers have disappointed, with the Purchasing Managers Index for May falling for the third month in a row. The PMI released by Kagiso Securities reached 51.1 points last month. That was from 55.2 in April. In February, it rose above 60 points. Joining me with more is Andre Coetzee. He's the head of fixed income at Kagiso Securities. Andre, thanks for coming in this afternoon.
Good afternoon.
Andre, although we are still expanding, anything above 50 is expansion, we seem to have lost some of that momentum we had in the first quarter of the year.
Now, we definitely have this 51.1, certainly not a great number. And I think you've mentioned it earlier, it's in line with what's happening globally. If you see what happened to the Chinese PMI, also expanding, but at a slower pace. So not a great number.
And of course, Chinese PMI could have a direct impact on our PMI because we are looking at growing trade with that country. So what China does really kind of has an effect on the rest of the world.
Yes, no, it's definitely concerning, and I think it would be quite interesting to see what the other PMIs do as they come out during the course of the day. But maybe if one can just take one step back, and I think, you know, in previous times when we talked about the recovery in the manufacturing sector globally and in South Africa, a lot of people said it was inventory driven, and it certainly looked like that was the case in the US. But if you look at our PMI, there were other factors that was driving our recovery in the manufacturing sector, which just sort of, in terms of our PMI, just showed that the recovery was just more than an inventory story, and the quality of the rebound was better than what happened in the rest of the world.
And of course, you're talking about new sales orders, because those new sales orders were really driving ours right at the beginning of the year. But if you look at the PMI leading indicator, which is new sales orders minus inventories, they've moved from plus 5.6 in April to minus 3.4 in May. What does this tell us?
Well, that actually tells us that underlying demand is not as strong as what it used to be. But I think one must be careful to look at 1 month's figure if you look at the leading indicator of the PMI, because that is a pretty volatile number. I think what one needs to do is just watch that number to see if there's not a trend sort of being established with the leading indicator of the PMI actually pointing to worse conditions going forward.
Andre, what's changed since the beginning of the year that's caused this deterioration in the PMI?
Well, I think first of all, if you look at the low base where we started out from, and we were just chatting earlier, it almost looked, if you see the recovery in the PMI and then also in some of the growth numbers, that we were heading for a V-shaped recovery. But if you look at the severity of the downturn at that stage, you know, when we were in the doldrums, nobody really predicted a V-shaped recovery. And I think we're seeing a more realistic picture emerging now. Sort of, you know, we had the recovery, but that the numbers are sort of contracting now, indicating that the recovery, sort of almost best case scenario, certainly in our view, is that we're going to see a slow and a protracted recovery. I'm worried if I look at the shape of the graph, you know, for instance, if we had to see a dip below that 50 number next month, it could almost indicate, you know, something or point to a double dip.
To what extent do you think the Transnet strike last month might have impacted on the PMI? Because we had a number of companies declaring force majeure. They couldn't get their products to port. Once they were at ports, they couldn't get them on ships. Do you think that could have had an impact on the May figure?
Yes, you know, in our report we actually state that is one of the, probably the explanations of the worst number. Also, you know, the ash cloud that combined with the trouble in Europe, I think all of that sort of contributed to this lower number.
Business activity down from 54.3 to 49, so a contraction in business activity, that means?
Yes, quite worrying, because if you just look at, you know, that is indicative almost of what's going to happen with manufacturing going forward. So really that's not a great number. And if you read that together with the employment index that's down below 50 again, certainly the alarm bells are ringing at this point in time.
Just looking at the sovereign debt crisis that we're seeing in Europe at the moment, lots of austerity packages have been announced by a number of countries in Europe. These are expected to lead to slower growth in Europe than previously expected. What sort of knock-on effect would that have on us? Because the European Union does remain our biggest trading partner, doesn't it?
Yes, no, I think it will definitely have a knock-on effect. And I think, you know, the feed-through is much quicker these days, and you can already see it in our PMI. I think, you know, the European sovereign debt crisis definitely had an impact on this lower number. And, you know, if that persists, it could even have a more of an impact going forward.
And of course, we've also seen the euro weakening significantly, and that makes our exports to Europe a little bit more expensive. So with lackluster demand and a weak euro, it's like a double whammy, isn't it?
No, for sure. No, and also, you know, but the one positive out of all of this is that we're probably seeing, if you look at dollar rand specifically, that we are seeing a little bit of a weaker rand, and you know that was one of the things that a lot of the manufacturers were complaining about, that the rand was too strong. So it's a little bit of a balancing act. You know, we see the worsening situation there, but it has got a negative effect on the rand. So this could underpin the manufacturing sector for some time.
Of course, when we saw the PMI head above 60 back in February, you did warn at that stage that we could see a bit of a pullback and then a sideways movement. From the levels we're at the moment, what would you expect from here?
I think it's very difficult to say. I'm a bit concerned, especially if you look at the leading indicator within the PMI. I think the next month or two is going to be critical. Are we going to dip below 50? And that would be a very bad sign. I'd feel much more comfortable if we see a bit of a stabilization at these levels, or a consolidation maybe between 51 and 53 for the next 2 months. And I think then we can say that the view is we're going to see the slow or protracted recovery, but a dip below 50 would be quite nasty.
There's been a lot of talk about the possibilities of a double dip recession globally, and of course we know those usually follow quite a while after a recession. What do you think the possibilities of this are?
I think there's definitely a possibility. You know, I think the last time China was sort of the saving grace for everything. But if we see something that would go wrong, because there's so many sort of underlying problems in the global economy, and China is still there. You mentioned India growing quite nicely at this point in time, but unfortunately that's a bit backward looking. You know, if we see these numbers, especially the PMI numbers out of China dipping, and if we see some problems coming out of China, maybe under par growth in China, I think then the possibility of a double dip recession is getting real, or more real, day by day.
Andre, we have to leave there. Thank you very much for coming in today.